You just finished a grueling month at work, slaving away flipping burgers. You get the email, you've been paid $2,000. But when you check your bank account, there's only $1,456 sitting there. You scroll down the pay stub and see the culprits: federal income tax, state tax, Social Security, Medicare. You are participating in the modern ritual of handing a chunk of your earnings over to invisible forces. These taxes are the mandated cost of civilization. You pay, and the government builds roads, funds schools, and makes sure your favorite taco truck isn't infested with rats. Which brings us to the actual paper we are stressing over. There is zero physical difference in legitimacy between a dollar bill and a stick. A dollar bill only buys you dinner because we, as a society, collectively agreed that it has value. The government prints it, and central banks regulate it. If they print too much, inflation kicks in and your cash turns into monopoly money. If they constrict it too much, nobody can afford to live. Money is a social construct built entirely on shared trust. To actually build wealth, you have to stop treating dollars like a law of physics and start learning the rules of a highly manufactured game. You walk into a bank, hand the cashier your cash, and assume it's sitting in a giant steel vault somewhere being guarded by a dragon. In reality, banks function as active middlemen for financial transactions. Through a system called fractional reserve banking, they only keep a tiny percentage of your actual cash on hand. This diagram shows exactly how that works. You deposit $1,000 into the banknote, but the bank instantly takes $900 of it and lends it to someone else who wants to buy a jet ski. The entire machine relies on the mathematical probability that not everyone is going to show up on the same day asking to withdraw 100% of their accounts. That is, unless people panic. When thousands of depositors line up to withdraw their money simultaneously, the lack of physical cash causes the entire system to crumble, precisely as it did in 2008. To manage who gets to borrow all this routed money, banks use credit scores. A credit score doesn't measure your actual wealth. It is a shadowy algorithm that strictly evaluates your trustworthiness based on your history of paying people back. The banking system is a matchmaking engine. It takes your deposits, pays you a tiny amount of interest to hold them, and then lends your cash out at a higher rate to generate its own profit. You might think keeping your cash hidden in a shoebox under your bed is the safest option, but money left completely alone is guaranteed to lose its purchasing power over time. Inflation happens when demand outpaces supply. If 2,000 people chase 1,000 TVs, the business raises the price from $500 to $800. To fight this, the government raises interest rates, making borrowing more expensive and immediately draining the pool of buyers. With consumer spending frozen, the economy cools off fast. Companies are forced to cut costs, mass layoffs suddenly begin, and unnecessary spending completely stops. This is a recession. It is a painful, mathematically necessary reset, designed to kill off unchecked inflation and bring the cost of living back down to earth. If currency constantly bleeds value, how do people actually get rich? The answer comes down to understanding perceived value. Think about gold. Physically, it is just a rock. But because it is shiny, yellow, and rare, humans have collectively agreed to place a massive premium on it over an average stone. Wealth is generated by manufacturing that exact kind of perception. A Gucci handbag can sell for 100 times more than a Target bag made of similar materials, entirely because people perceive it as more valuable. Steve Jobs understood how to manufacture immense societal value. He built a device so inherently useful that millions of people willingly traded thousands of dollars of their own labor just to acquire it. True wealth isn't achieved by hoarding cash under a mattress. It is achieved by creating, providing, or owning assets that hold high perceived value to society. To survive the slow erosion of inflation, your money has to stop sitting idle and start acting like an unpaid employee. You have to invest. This chart shows compound interest. Invested dollars create clones earning rent, driving exponential growth. But beware, 20% interest on credit card debt turns a $12 burrito into a financial fire. Invest consistently at 7% and your wealth multiplies. There is one strict requirement for this math to work: patience. Real wealth is built in decades, giving compound cycles the runway needed to multiply. time is the ultimate currency.
Ordinary people retire with 7 figures, not by finding magic tricks, but by learning the rules of the system, investing consistently, and letting time do the lifting.